real estate is hyper local. As an investor, we're probably going to be 6 to 12 months behind the curve. Our job is not to hit the bottom perfectly, right? Buy at the lowest point. I would rather be a year or two late to the party on growth than 6 months too early.
Welcome back to Pending and Trending. I'm joined today by Whitney Elkins-Hutten, Director of Investor Education at PassiveInvesting.com, founder of Ash Wealth, and the author of Money for Tomorrow. With a portfolio spanning multifamily, self-storage, car washes, and real estate debt exceeding $800 million, Whitney helps professionals and business owners grow and protect wealth through tax-efficient passive investment strategies. In this episode, we cover Whitney's accidental start in real estate, why true diversification means looking beyond asset classes to the layers of capital stack, red flags to watch for in passive deals, and the hidden opportunity most investors are missing in their portfolios. We also dig into her book, Money for Tomorrow, and what it really takes to build a financial foundation that lasts. Let's get to it. So tell me about your journey. How did you build and grow your portfolio from the ground up? How did you get started?
Yeah, I say that a little tongue in cheek. I've always been really driven to get my time back to, I've always, since, a teen, I've always been a very driven person, always wanted to do things the most effective and efficient way. And, it really, but I followed the same narrative that most people do. Go to school, get a good job. I did things a little out of order. I bought a house, then, found a partner, instead of usually it's, get married, buy a house, have a kid, right? That type of thing. But anyways, I bought a house with a significant other, and about a month later, the relationship fell apart, and I had the property. I did do one move correctly. I put everything under my name. I was the I was the one that had the loan. I was like, okay, and we weren't married or anything, so it was but still, that was something we had to untangle in our relationship. But I had this house, and but I also had all the bills afterwards. So I stuffed it full of roommates. It also needed a rehab, like green shag carpets, psychedelic daisies, painted all over the walls, straight out of the 1960s. And I was the money partner in the deal for all intents and purposes. I had no idea how to do flooring and carpet and drywall and remodel a kitchen. Learned how to do all that. And paid my friends in pizza and beer and sushi and got the house put back together and sold it 11 months later. I honestly thought that this house was going to sink me financially. Sold it. And at the closing table, the title company hands me a $52,000 check. Then a couple weeks later, I'm doing my taxes and I'm like, wait a second, I didn't pay for anything here, and I made $52,000. Oh, by the way, I had borrowed $7,000 from my grandparents, and had paid them back. And I was like, I just took $0 and turned it into $52,000, which was almost as much money as I was making in my day job that had me traveling. And I'm like, wait a second, this is far more efficient income than me spending my time and energy, working for somebody else. Also simultaneously, what was happening at the same time is my dad was really ill, and all I wanted to do was be there to, spend time with him. We didn't know what was going to happen with his health, but more importantly, to help my mom. I mean, she was a caretaker working full time. And, my dad required a lot of energy to take care of at that point in time. And I wasn't allowed to. The job said, like, hey, you get 2 weeks vacation a year. You take any more than that, then we got to fire you. And so I had these two, this desire to have control and choice over my time. And then everybody from every angle saying that you can't have it. And that was when I sold this property. That was when the light bulb came on for me. I'm like, wait a second, there is a way for me to take my time and energy and build skills to create freedom of time and choice for myself. It's easier if I have a little bit of capital to do that, but I don't have to have money in order to get started. And that really just kicked me off my journey. It was completely by accident. Snowballed from there. I did several more live and flip projects. then eventually turned them into rental properties, stopped flipping them, started putting tenants in there to create cash flow, and then leveled up into larger projects and in order to get economies of scale. And then, now where I'm at in the phase of my investing career is not focused just on the equity growth side of real estate, but also how can I create stabilized income from the real estate that is independent of the actual performance of the property. And so that's where I do a lot of note investing and note fund investing right now, especially in this phase of the market cycle with all the volatility that we're seeing. So yeah, that's a little synopsis of my journey.
Okay, well, what a journey. So that's so fill us in on exactly what you're doing now, and then I will kind of backtrack a little.
Yeah, so professionally and personally, I invest in debt funds. Professionally, I am the director of investor education at passiveinvesting.com, and I educate and help people place capital into our real estate debt fund, which is essentially a pool of loans that secure the first lien position on single family houses that a lot of people are that other borrowers are fixing to flip and sell on the market, or fixing up and putting in their portfolio as rentals. There's a little bit of mobile manufactured home investing and stuff like that in there. Personally, that's what I do too. I found, I think everybody really drank the Kool-Aid in the past 5, 6, 7 years, was like, real estate's amazing. You can get income, equity growth, tax benefits, all in this one vehicle. And yes, you can, but you still have to remember to diversify. If all you are carrying are equity investments, if all you're carrying are the ownership of all these properties, whether it's actively you own them or passively you own them, you're still exposed to the highest risk, highest reward part of what I call the capital stack. Okay. And you're just one market turn, one rate adjustment change, or whatever it is in your market, whether it's insurance going up, like if you're in Florida, you're just one market change away from your cash flow compressing, your equity compressing. So true diversification in the real estate space requires you to diversify across the different layers of the capital stack. So don't just think asset classes. Think about also the different layers that go into an asset. Meaning, are you holding some properties where or debt funds where you're the senior debt on a property? Are you going into more opportunistic positions, say in secondary loans or preferred equity deals? And then do you have your portfolio in equity? If you were investing in the stocks, in the public equities, it would be, are you diversified across stocks and bonds? And in the stocks, do you have growth stocks? Do you have value stocks, right? So we need to create that same type of diversification within our real estate portfolio.
And how do you help people do that? And how do you help them make the best decisions?
Well, with what I do at passiveinvesting.com, it's from an educational standpoint. We're not financial advisors, so we'll have a conversation with people about what their investing goals are, what have they done already to date, maybe identify some glaring holes in their portfolio that they should consider, and then we provide them the education they need and the materials they need to make a good decision about the offerings that they're seeing in the market and how ours stacks up against theirs, what they're seeing in the market. With my work at Ash Wealth, I get to go a little bit deeper. Again, I'm not a financial advisor, but I get to sit one-on-one with somebody and we go line by line through their portfolio. And we will really help them pick apart where that risk is showing up in their portfolio, and then help them create a clear plan, putting together what I call a decision gate for themselves. It's so tempting whenever you get into this real estate space is to see what other people are doing and going, oh, that worked for Deidre. Amazing. I'm just going to copy that and do it for myself. Well, you and I have different priorities in our life. We have different goals. We have different risk tolerances. And so we have to be able to sit with those questions and figure out what it means for ourselves, and then create all of our tools, our decision-making tools, around what's right for us. And so, yeah, you can download somebody's due diligence checklist offline. Amazing. But if you haven't done that core work for yourself, that tool is going to point you to the wrong asset.
That's great. That's good advice. So if we look at the market, the 2026 market where we are right now, what are some advantages of either passive real estate equity or debt strategies or different passive investment paths? So I know we mentioned briefly storage, car washes. What are some benefits? What are some advantages?
Let's go back to like the 2026 market. Okay, when you're talking about we can read the headlines, right? Like when you read the headlines on CNN News or whatever, like they seem very generalized. But the thing is, real estate is hyper local. Okay, so multifamily in the Midwest might be on fire, but multifamily in the Southeast may not be right now. Okay, so we have to, even within an asset class, we have to drill down to what's happening in that local market. And so when you're an investor and you're looking at a market, you're looking at where is that market in the four phases of real estate. Is it in the hyper supply? Are we seeing a lot of supply still come online, say like in Austin, Texas, or Phoenix in Arizona? Okay, when you're in hyper supply, it's kind of like a race to the bottom. People have to be really hyper competitive on their rents that they're offering. They might offer concessions to get people into their property, whether it's a multifamily or into a storage unit. And you're going to see kind of this race to the bottom. But eventually those units will absorb. Okay. Especially if your population is still growing, business is still growing, income is still growing. Those units will absorb, okay, because construction stopped. And then we hit the recessionary part of the market. Prices and bottom out, valuations and bottom out, and then you start moving through the recovery part of the cycle. Here's the thing, as an investor, we're probably going to be 6 to 12 months behind the curve. Our job is not to hit the bottom perfectly, right? Buy at the lowest point. I would rather be a year or two late to the party on growth than 6 months too early. Okay, so as a passive investor, I'm going to watch those trends. Has that absorption occurred? Are our rents starting to increase? Are we actually starting to see bank lending coming back into the space? Are we starting to see construction permits being drawn? Remember, the time for permits to the time of breaking ground, that can be 5, 6, 7 years, right? So if we start seeing this, signs of recovery, that might be the time for me to start looking at the market. Okay. But remember that equity piece, whether you're doing multifamily, self-storage, express car washes, that's just one, that's equity. We still have a whole other asset class here that does well in any part of the market cycle, and that is fix and flip real estate debt. Now, I'm very specific about fix and flip real estate debt because the borrowers that go to these hard money lenders are very price agnostic, meaning they paid 11 to 14% to secure that money to do their fix and flip project. They don't care. They want speed. They want customer service. They want to know that that lender will close. They're not looking to hold that loan much past 6, 9, 12 months. Anyways, that type of lending, those type of funds do really well in nearly every part of the market cycle. Now, I really, where I say if it's a depressive part of the market cycle, if we hit a depression, all bets are off. Everything's in trouble.
Of course. So when you're looking at a new passive deal and you're evaluating it, what are some red flags that are non-negotiable for you?
Ooh. So, again, this is going to differ between debt and equity. But, for me, I'm looking at we're going to take debt first, I'm looking is that debt in first lien position, meaning am I the first borrower? Now, it doesn't mean that second loan or tertiary loan, unsecured loans can't be a good investment. I just need to know that those are more opportunistic deals. And me personally, I'd rather be in an equity deal than take on those risky debt positions. Now, here's the sneaky one. We see a lot of debt funds that say, hey, all of our loans in the debt fund are first position loans. But you read the PPM, they will go get a bank line of credit. So they take your money to the bank to go get more money in order to lend. So you as the investor, you're not in first position. You're actually in second position or equity. Again, I would consider that risk and maybe go into an equity deal if I was going to get kicked down the pipeline like that. I don't want to be, if I'm going to be behind the bank, like, let's make some money. Let's go on the equity side of things, right? Let me get some tax benefits. Okay, so that's, again, where am I? How am I being secured? Am I in first position for debt? Same thing on equity. How am I being secured by the property? Leverage, is leverage being used? If I'm going into a debt fund, I don't want leverage. Remember, I'm supposed to be in debt. I want to be the first debt, the first rights to claim on that property. Now, if it's an equity deal, more than likely there is leverage, but I want to investigate that leverage. What kind of leverage? How much leverage? Is it bridge debt? Is it floating rate debt? What are all the ways that the operator is mitigating that leverage risk? Then I'm going to evaluate the asset class. Okay, where is that asset class in its market cycle? Okay, is it something like real estate debt funds that are typically can be pretty hot in any part of the market cycle? Are they well diversified? Is that market? Is there plenty of business in that market? Are days on market for those deals expanding? If it's an equity deal, again, I want to evaluate in that market. How is multifamily doing? Okay, are there too many units that have already been overbuilt? Or have they all been absorbed and I'm starting to see rental prices increase? Then I want to evaluate on that particular asset itself, where is that asset in its developmental phase? Is it stabilized? Meaning it really, maybe just some new paint, carpet, I can bump the rents a little bit. Is it some sort of value add strategy where maybe I got to rip out a kitchen, but I'm not moving walls, electrical, or anything like that. I'm not opening things up to create surprises. Is it developmental, meaning I'm actually moving walls, redoing foundations, ripping off roofs, okay? Or is it something more like ground up development, meaning I have raw land that I now have to entitle and then I have to build on? Each one of those developmental phases carries its own risk profile too. So as you can see, those are just four different categories. I have different scaling of risk in each of those categories. When I throw all those ingredients together, I can have something that's super conservative, or I can have something that's hyper risky. And I think that's where an investor really has to get super savvy on how to blend those things together. Now that's just around the asset itself, some of the flags that I like evaluating. But once we pick the asset, something that we really want to deep dive into, now I go into the people that are running the deal. What are my red flags there? The processes that they have in place. We can pick that all apart. Are there any red flags there? And then what protections do I have as somebody who's going in on that deal as a limited partner? What protections for my capital are in place, and what red flags exist? Now, there's one other ingredient on top of here that's a huge red flag: fraud. If somebody, in the news been known to take money as a Ponzi scheme, those type of people we want to evaluate and we want to get out of our lives. No matter how juicy the returns may look, we don't want to invest in fraud.
Absolutely, absolutely. So where would you see is a hidden opportunity right now that many real estate investors are completely missing?
Well, I wouldn't say hidden. If it is, it's hidden in plain sight. I think a lot of real estate investors, be it active or passive, if you looked at every single asset in your portfolio and you put it in one of three categories, either it provides reserves, emergency reserves, emergency capital for you. It provides straight on income regardless of performance of the asset, or it's an equity deal where its income, be it cash flow or equity, is based on performance. I would imagine most real estate investors, these are the people that I end up coaching too, they categorize all of their assets, and they realize they got a little bit of reserves, maybe like 3 or 6 months, not that much, and they got a whole pile of equity assets. What they're lacking in their portfolio, where the opportunity is right now, is to build out that nice income producing, stabilized income producing tier of their portfolio. That's what's going to help keep your oxygen mask on, your lifestyle running, when your cash flow and your equity compresses on your other equity assets. And so that's, again, part of the opportunity that I started building for myself starting back in 2019. But moreover, what I do, spend a lot of my time with my investors, helping them understand what the risks are showing up in their portfolio and filling out the hole. And the most common hole that I see is that, do you have income that comes in like clockwork on a monthly basis that does not require that asset to truly perform?
Understood. So what's one of the first steps that you would say our listeners need to take sooner rather than later to ensure that their money actually starts working harder for them?
Oh, gosh. I wrote a whole book on that, by the way, Money for Tomorrow.
Good. Well, that's a great segue to that. Let's talk about your book too.
Well, because it all depends, right? It's the classic real estate answer. I would say, every investor I've ever talked to usually has what I call a leaky foundation. Maybe it's a major leak, maybe it's just a super minor leak, something that they glossed over. They once did, maybe tracked their income and expenses, but now they're making clearly making, or they're successful in their investing, but they've kind of like taken their foot off the gas pedal in the basics. So going back to basics, I think, is one of the things that I would suggest anybody do. Let's make sure that you have a very strong financial foundation. How are you tracking your income and expenses? How diligent are you there? Have you plugged all your big money leaks in your system? Do you have what we call an investor thesis set up? Remember, we alluded to it, earlier in the show. What are those decisions around your goals, risk, and timeline? So you don't get suckered into following somebody else's bright ideas, but you can actually take somebody else's bright ideas and evaluate if they work for you or not. Then, do you have all of those due diligence tools for your investment built upon your investment thesis? And then the last piece is like, okay, great, you're amazing at, building wealth. How are you protecting it? All right. And a lot of people think, oh, I've got a will or I've got a trust. That's all I need to do. No, we need to think about, what happens if you slip, trip, and fall and bang your head and you don't die? Like, is your wealth protected? Do your kids know what to do? Like, your heirs for your estate, are they trained? Do they know what to do with your wealth? Do they have the skills to take what you built and, grow it for their generation and beyond? So again, it's kind of a sliding scale. People are going to, pick up that foundation in different areas, or they might find that they're really strong in tracking their income and expenses and investing, but they're losing so much money to interest rates that they're paying and, investment fees. And then they don't have their financial fortified, like around what I call the past part of the financial foundation. That's usually what I see, but that would be kind of the first thing I would do, is do that deep dive analysis. Is your foundation solid? Where do you need to be fortified? And let's build the skills from there.
So many important things to consider. So you wrote a book. Let's talk a little bit about your book. It's called Money for Tomorrow. Is that right? And tell us about your book, some of the important lessons that you are, passing on in the book, and I'll let you take it from there.
Oh, awesome. Well, yeah, the book Money for Tomorrow, How to Build and Protect Generational Wealth, you can snag that on Amazon or Bigger Pockets. I wrote it with Bigger Pockets Publishing. It's the book's concept. I mean, we went over, it's about how to secure your financial foundation. So any investment you put on top of that is fortified. Okay. Like if I don't know, if you've built like Legos recently. I mean, my child, she's 14 now, but like it wasn't that long ago that we were building Legos, and we had to teach her how to build a good foundation with the Legos. Otherwise, like things were toppling over. I see a lot of investors do that. They get so drawn to try to add wealth as quickly as possible to their portfolio that they forget that, executing on the basics are just as important. And so this book walks you through those basics. It gives you the business plan that I wish all of us would have learned in high school on how to create money, how to keep it, how to get all those nasty, things that drain our wealth and our energy out of our life, how to put together those systems to know what we need from our portfolio, but more importantly, how to evaluate deals we're seeing, both public and private deals, and what belongs in our portfolio or what we're aspiring to, and then how to put that fence around them and protect them and pass them on. And so we go through each one of those 4 categories in pretty deep detail. And all of these are stories, lessons that I learned in my life the hard way.
Well, thanks for cutting to the chase and sharing them with us.
You're welcome. But I mean, that's a lot of people that I talk to these days are like, oh, I don't read the book anymore. I just like, punch in ChatGPT or Claude, like the book title, and it gives me a synopsis, and then away we go. And I'm like, what you're missing are all the stories and the struggles that somebody had that led them to writing that book. And that is almost just as valuable as the frameworks they're teaching, because now you know why those frameworks are in place. And now you know how to not repeat those mistakes that they had. So you can go create your own mistakes, right? Like, it's not like it's going to eliminate all the mistakes in your life, but that for me, like, was the most amazing part of like writing this book. And I'm like, well, great. Like, now I know what to teach my daughter, and she's not going to repeat what I did. She's going to go make her own mistakes.
That's right. At least you give her a little head start to hopefully she doesn't make the exact same ones and advances to the next phase faster.
Exactly.
So thank you so much for being on with us, Whitney. How can our listeners reach you if they'd like to get in touch?
Yes. So a couple different ways. If you're interested in adding, predictable income to your portfolio and figuring out ways to also allow that income to grow, you can reach me at passiveinvestingwithwhitney.com. And if you need one-on-one help, specifically in creating your portfolio, all those rules that I talked about, you can reach me at ashwealth.com.
Whitney, thank you so very much for being on and for sharing such practical wisdom from building your investor thesis to fortifying your financial foundation before chasing the next deal. If you want to connect with Whitney, find her at passiveinvestingwithwhitney.com or ashwealth.com, and be sure to check out her book, Money for Tomorrow. Thanks for listening to Pending and Trending. We'll see you next time. If this episode was helpful, check out the next episodes of Pending and Trending for more real conversations around building wealth and financial freedom.